Hello and welcome to another of our In Conversation series. Today we're discussing private equity. Despite mixed headlines regarding exits, returns and the wider IPO market, in 2024 the assets under management of evergreen PE funds in the US actually grew. Joining me to make sense of it all is Alisa Wood. She's a partner in private equity at KKR, a firm with 5 decades experience operating across multiple economic cycles and political environments. Alisa, welcome.
Thank you.
Why are wealth investors, why are they allocating to private equity?
I think there are a few key reasons. One, the relationship between public and private investing has fundamentally changed. There are 40% fewer public companies today than there were 20 years ago. So if you're only investing on the public side, you're actually losing a lot of opportunities to put capital to work. Second is the correlation between asset classes have fundamentally reversed. Things that weren't correlated now are highly correlated, and you need more diversification in an asset allocation to really make sure you're maximizing returns. And third is the secret of private equity, right? This whole concept of private equity delivering a premium over the public markets is one that individual investors should have the same access to that large institutional investors have done for 20, 30, 40 years. But with the birth of evergreens and the proliferation of them, it's given them more ways to actually get access to that less correlated return stream that actually allows closing of the gap in terms of performance in an asset allocation.
Why is manager selection? Why is it so crucial when you're investing in private equity?
I always joke that it's the who, not the what. There are thousands of private equity funds in the world. I think the latest stat in the last 10 years, there are 19,000 private equity funds, and they all can't be winners. It really comes down to how you generate returns. The dispersion of return between your best managers, first quartile, and not even your fourth, but your third quartile managers can be over 1,400 basis points of return dispersion. So if you're not able to access the best-in-class managers, you probably shouldn't do private equity. And it really comes down to being cycle tested, having the resources to support it, and really creating your own luck by driving bottom line performance of the companies you're investing in.
Let's talk about exits and deployments. When it comes to private equity deployment, we know there's been some slowdown with the market complexities right now. How are you navigating at KKR that environment?
If you look at KKR this year alone, we have announced and signed almost 25 new investments, and we've realized we have exited either partially or fully over 20 companies this year. It's all about buying good companies you can make great. It's all about buying businesses that have multiple ways to win. If you're waiting around for the IPO market for a small window for you to exit your investment, you may be waiting a while, and that may be a lot more challenging. Less than 20% of our exits are actually through IPOs. Nothing wrong with that, but we're not reliant on that. Over 60% of our exits come from some type of sale to a strategic. But it's all about buying complexity and creating simplicity in our growth. That gives us multiple ways to win to return capital back to our clients.
Alisa Wood, thank you very much.
Thank you.